Good morning, good afternoon, good evening, ladies and gentlemen. Welcome once again to our episode on the world of investment. So this is just a continuation. So today we're going to look at the build a diversified portfolio. We said the portfolio is just a financial investment. So in the case of investment, really, it is all about decisiveness, making that decision, not to wait for the right time or the wrong time, or this is right or wrong, it doesn't matter. So nothing seems as it is in the world or the world of investment. Nothing seems as it is, meaning that certainty is a dream. So we're going to look at understand the importance of diversification. Diversification simply means like having your assets or investments all over the place, spreading them all over the place. Number two, we're going to look at the diversify across assets classes. Asset classes simply means stock, bonds, real estate, commodity, and all of those. Those are like the asset classes. Number three, we're going to look at the diversify within asset classes, within the asset classes. Number four, we're going to use number four, it will be use index funds and the ETFs. So the exchange traded funds, those are the ETF. Number five, we'll look at the rebalance your portfolio regularly. Like keep going back to the origin. So portfolio is just financial investments. Then number six, we're going to look at the consider risk tolerance and time horizon. And after that, I'm going to give a conclusion or quick summary at the end, just as I usually do in all the episodes, just to sum up everything really, so that we get the sum up so that we get a sum up of what we went through. So you ready, ladies and gentlemen? Tighten your belt and let's begin. So you don't have to keep everything formal. You can keep it informal as well. It's all about learning, enjoying what we're learning. So build a diversified portfolio. So diversification, it's like a long word. Diversification is a key principle in investing that involves spreading your investments across various asset classes. So we said asset classes can be bond, it can be stocks, it can be real estate, commodities, it can be cryptocurrencies. All of those are asset classes. So it can be like various asset classes, excuse me, industries and geographical regions as well. Those are like the places where you have to spread your investments. Different asset classes, industrial as well, or industries. Like we can say in the case of industry, it can be like in the technology or agriculture. And geographical regions as well, different geographies, different places. So the goal is to reduce risk by ensuring that the performance of one asset or sector does not overly impact your entire portfolio. So try to reduce the risk as well. We already saw in the last video how to assess your risk tolerance really. Now we go in number one, understand the importance of diversification. Reduce risk. So diversification helps mitigate risk by not putting all your eggs in one basket. So don't put all your eggs in one basket. So if one investment performs poorly, others may perform well, balancing your overall returns. So that's what we want. So don't want to put all your eggs into one basket. You need a backup. Instead of just investing in stocks, you need a backup maybe in the bonds. So the example, I always focus on the practical examples, because we need them really to understand the imaginative part as well. So if you only invest in tech stocks and the tech sector crashes, your entire portfolio could suffer. So if you just focus on the tech sector, just in stocks, and the tech companies fails or crashes, then it will impact all your entire portfolio as well. So your entire portfolio could suffer. However, if you also invest in bonds or other industries, the impact of that crash will be less severe. So that is the concept of diversification, spreading investments all over the places. So it's like betting different places instead of putting all your eggs into one basket. So that's the whole concept. So smooth out volatility as well. Like different assets often perform differently under various economic conditions. Consider the economic conditions as well. Like diversification can help smooth out the volatility in your portfolio, making your investment experience less stressful. You want to make it less stressful to become successful, not having too many stresses, high pressure and high blood pressure and all of that. So the example of smooth out volatility, it will be like when stocks are volatile, bonds or real estate investments might remain stable, like reducing overall portfolio swings as well. So you don't want the swings back and on, the pendulum swing right and left. The swing to the right is equal to the swing to the left. You don't want the swing. You want to avoid the pendulum swing. So you want to find an equilibrium, transcendence really, to go above the swing. In the case of marketing, it is ups and down, fluctuations of the marketing prices. So we can look at the maximize potential returns as well. We still are under the number one, understand the importance of diversification, maximum potential returns. So while diversification primarily focuses on reducing risk, so it can also increase the potential for returns by exposing your portfolio to a broader range of investment opportunities. So it can also expose your portfolio to a broader range of more investment opportunities. Like instead of just investing in one place or one company, you can invest in 100 more companies. If one or two fails, you still have 90% or 80% chance guaranteed to get your input or your return back. So number two, it would be diversify across asset classes. So we said asset classes can be a bond, it can be stocks, it can be real estate, it can be the ETF, the exchange traded funds, or it can be just cryptocurrencies. So in the case of diversifying across asset classes, we look at the stocks. So stocks are simply equities. So equities are often the growth engine of a portfolio. The growth engine of a portfolio simply means there's a higher growth or higher return, higher risk as well. So stock can offer high returns, but they also come with a higher risk as well at the same time. Higher return, higher risk. So the higher risk is directly proportional to higher return. So if you take less risk, you're going to expect less return as well in the case of bond. So the example for stock, it would be like investing in a mixture of large cap, mid cap, and small cap stocks can provide exposure to companies of different sizes and growth potential. There's like you have done the diversification really, trying to divide them all of the places. So in the case of bonds, so bonds provide stability and income to a portfolio. Stability is something like the equilibrium, being stable. So they are generally less volatile than stocks and acts as a counterbalance during market downturns. So it acts really as a backup during the market downturns. The example for bond, so it will be like including government and like the corporate bonds in your portfolio can help protect against stock market volatility. So put like government bonds and corporate bonds as well. Just having diversification, that's the whole concept, dividing different places. Now we're going to look at the real estate. So real estate investments can provide diversification benefits because they often have a lower correlation with the stocks and bonds. Lower correlation or lower relationship with stocks and bonds. So in the case of real estates, those are like the commodities, or real estates is like the rental properties. So the example it would be like the real estate investment trust, the REITs, real estate investment trusts. Allow you to invest in property markets without directly buying real estate. So that's actually good. Imagine investing in the property market without even owning a real estate. So now we're going to look at the commodities, different asset classes. So in the case of commodities like gold, oil or crude oil, and agriculture products can offer protection against inflation and add another layer of diversification. So we said inflation, just the rise of prices in a given period or given time. So in the case of diversification, so in the case of commodities as well, if you buy gold or crude oil, agriculture, so simply diversified really quite different products. So can offer protection against inflation and add another layer of diversification. So the example of commodities, like investing in like commodity focus, the ETF, exchange traded funds, can provide exposure to this asset class without the complexities of buying physical commodities. So without even buying physical commodities, you can still invest in the commodity market as well. We're going to look at the cash and the cash equivalents, So in the case of cash, we're simply talking about liquidity here. So it's all about cash, save up accounts, emergency accounts, or saving accounts. So holding some cash or cash equivalents like money market funds, like money market funds can provide liquidity and safety in uncertain times that like market drop down as well. So in the case of liquidity, simply like saving account or cash in emergency, like in emergency cases. The example of cash and cash equivalents, it will be like keeping a portion of your portfolio in cash allows you to take advantage of buying opportunities during markets, dips, ups and downs. Number 3, we're going to look at the diversify within asset classes. We said asset classes is just like the financial investments, bonds, stock, real estate, and things like that, and commodities or crypto as well. So we're going to look at the stocks under the heading of the diversify within asset classes. So with stocks, like within stock holdings diversify across different industries. Example, technology, healthcare, and finance as well. And geographies, like example, the USA, like US, like United States, UK, United Kingdom, and emerging markets as well, like new markets you're trying to invest in them as well. So it's trying to look into stocks in the emerging markets as well. So the example, it will be like, instead of only investing in US tech companies, consider adding healthcare stocks, European companies as well. If you live in US, consider European companies as well, European companies, or any emerging market stocks as well, just new ones, explore the new updates on the new options too. In the case of bonds, diversify your bond investments by including different types, e.g. or example, like government versus corporate, and the durations as well. So in the case of bonds, you have to wait the bonds to mature. You might say 3 years or 2 years or 10 years in the long term. Like in duration, it can be like short term versus long term as well. The example, so a mixture of US treasury bonds, municipal bonds, and corporate bonds can offer balance of safety, tax advantage as well, and yield. So in the case of yield, it's like from continuous transactions like buying and selling, which might affect your tax as well in the case of taxation. So real estate, we still under the diversify within asset classes. Real estate, if investing in real estate, consider diversifying by location and type. So in the real estate, it's like buying a residential, like rental property. So it's all about property really. Real estate, though all of those are assets. So in the case of investment, we're simply focusing on assets, not liabilities. So e.g. like residential, commercial, industrial, all of those are like real estate. You can buy maybe a company or just a rental house. So the example of real estate, like a portfolio, which is just a financial investments, that include residential properties in major cities. So you have to consider major cities who are built-up areas. And commercial real estate in growing regions can balance risk and return as well. Number 4, we're going to look at the use index funds and the ETFs. So ETFs is just the exchange traded funds, use index funds, and the ETFs. So cost-effective diversification. So index funds and the ETFs are excellent tools for diversification because they allow you to invest in a broad range of assets with a single purchase. So with a single purchase in the index funds and the ETFs, it will allow you really to invest in different departments or broad range of assets as well. So in the ETFs, maybe you can invest like 100 companies. If one or two of them fail, you still have a high probability to get your return back, your input back. So the example of index funds and the ETFs, like a total stock market index fund provides exposure to all sectors of the economy, while a bond of ETF can offer a diversified bond portfolio. So you've been exposed really to a wide range of assets. With global exposure as well, So many index funds and the ETFs offer global diversification, providing exposure to international markets, which is good as well, without the need for complex research. So without the need of complex research, if you just invest in ETF or index funds, the exposure as well, like different countries, different continents. So the example, like for an international ETF, gives you access to global markets, spreading risk across different economies. So instead of you worrying about the risk, the ETF just do all the work for you. Number 5, we're going to look at the rebalance portfolio regularly. So in the case of rebalance, we put more emphasizes here as well. In the case of rebalance, like going back to the origin really. So if you had like 70-30, 17 bonds or stocks, or 30% in bonds, so you can try to rebalance if your stocks goes higher, like 80% instead of 70. That's all about the concept of rebalancing, going back to the root where you started or you target really. So monitor asset allocation. In the case of monitor asset allocation, going back to the targeted or original percentage. So over time, the performance of different investments will cause the portfolio to drift from its original allocation. So when it drifts, you try to go back as well. So you keep looking, you keep reassessing, you keep trying to check over time, maybe try to rebalance. There's a correct word. So rebalancing helps you maintain your desired risk level by selling overperforming assets and buying underperforming ones. So try to rebalance. If it goes above, then try to bring it down. Selling and buying over time, not frequently. So the example of that will be like if your stocks have performed well and now make up 70% of your portfolio instead of your target of 60%, rebalancing might evolve like selling some stocks and buying more bonds. So trying to rebalance between stocks and bonds, because the stocks are high risk one with a high return. Bonds are like lower risk with lower return as well. So set a rebalancing schedule. So you can rebalance your portfolio annually, like every year or per year at the end of the year, or semi-annually, or when your asset allocation deviates or goes off so significantly from your target. That's when you can set your rebalancing schedule. In that case, the example would be like some investors rebalance when their asset allocation shifts by 5% or more from their target. You can say 5% or 15 or 10%. So it is up to you now to set that target. So if it goes above 5%, you try to rebalance going back to the original between bonds and stocks. You try to rebalance them. Then number 6, we're going to look at the consider risk tolerance and the time horizon. That's the last video which we just did, the risk tolerance. Know about yourself, know yourself really. So align with your goals in the case of risk tolerance and time horizon. The time horizon, we say like you have 30 years, you want to retire at 60 years. You have 30 years gap or time span before you retire. So you still have more time in your case if you're still a youth. In the case of 55 years, you want to retire maybe at 60 or 65 years, go like 15 years or 20 years, so it doesn't have enough time. So instead of course investing in stocks, you can invest in bonds instead. So align with your goals. Your portfolio diversification should match your risk tolerance and the investment time horizon. The example I just give you a quick one. So young investors with a long time horizon can afford more risk and may have a portfolio heavily weighted in stocks, while old investors may prefer a more conservative mix. So instead of relying too much on stocks, you maybe have 60% on bonds and 40% on stocks for old investors, like between a high percentage in bonds and then instead of stocks. So the example, it would be like a 30 years investor might have 80% in stocks and 20% in bonds, while a 60-year-old might have a 50-50 split. Number 7, we're going to look at the avoid over-diversification. Avoid over-spreading investments all over the places. So nothing in excess, really. You try to keep it balanced. So balance, don't overwhelm or don't exaggerate it. So while diversification is important, over-diversifying can lead to mediocre returns as well. So there's a risk as well if you would overdo it or overwhelm it, or if exaggerate it really. So if you spread your investment too thin, you might miss out on the growth potential of individual assets as well. You have to consider that, put that in your mind. So the example, like holding too many similar mutual funds, can lead to redundancy or loss or reduction without adding much extra benefit. So focus on a well-rounded but not every complex portfolio. So what can you say in conclusion about all of that? Really, diversification, like instead of putting your eggs into one basket, you try to spread them all over the places, but don't overwhelm it, don't overdo it, don't exaggerate it. It's all about this. So in the case of asset classes, we have stocks, bonds, real estate, commodities, just gold, crude oil, agriculture as well. Those are like the commodities. In the case of real estate, just rental, industrial, and things like that. Really, those are like commercial as well. So in summary, what can we say, ladies and gentlemen? So building a diversified portfolio is a chief cornerstone of sound investing. By spreading your investment across various asset classes, industries, and regions or geographical regions, you can reduce risk and increase your chances of achieving consistent long-term returns. So regularly rebalancing your portfolio, which are just the targeted financial investments, and aligning it with your financial goals and risk tolerance will help you stay on track toward building wealth and securing your financial value, which is all we're all looking for, that really, which is based on the financial security and having that peace of mind. Excuse me. This is what we're actually looking for, all of us. We're looking for financial security and having peace of mind. So ladies and gentlemen, don't forget to like, comment, share, and subscribe. We want to hit 1K, and keep commenting as well. If you've got any question or investment, keep dropping your questions in the comment section. Thanks for watching. Ciao. Bye.